Welcome to Living Matters, your go-to channel for in-depth financial insights. Today, we're diving into the most critical aspect of the newly proposed Income Tax Bill 2025, capital gains tax. How does this bill impact investors, homebuyers, and businesses? Stay with us as we break it down in simple terms. Before we get into the changes, let's quickly understand what capital gains tax is. In India, capital gains arise when you sell an asset for more than its purchase price. These gains are classified into short-term capital gains. If the asset is sold within a short holding period, taxed at a higher rate. Long-term capital gains, if the asset is held longer, taxed at a lower rate, sometimes with indexation benefits. The big news: the new bill does not change the existing tax rates for short-term and long-term capital gains. This means, equity short-term capital gains, held for less than 1 year, is taxed at 15%. Equity long-term capital gains, held for more than 1 year, is taxed at 10% on gains exceeding 1 lakh rupees. Non-equity assets like real estate and debt funds, short-term capital gains are taxed as per income slab rates. Non-equity long-term capital gains is taxed at 20% with indexation. For those selling residential property purchased on or before July 22, 2024, the government has introduced a new flexibility. You can choose between paying 12.5% tax on gains without indexation, or paying 20% tax with indexation benefits. What does this mean for home sellers? If your property's value has significantly appreciated, the 20% tax with indexation may be beneficial, as indexation adjusts the purchase price for inflation, lowering taxable gains. But if appreciation is moderate, the 12.5% flat tax might work better. The Income Tax Bill 2025 is designed to simplify tax administration and bring India's taxation in line with global standards. Some key terminology changes include: tax year replaces assessment year, previous year replaces financial year. These updates aim to make compliance easier for taxpayers and ensure clarity in reporting. So, how will these capital gains tax provisions affect investors? For equity investors, no tax rate changes mean stability for the stock market. For property sellers, the choice between 12.5% and 20% tax could significantly impact post-tax profits. For long-term wealth planners, with indexation benefits intact, real estate and gold remain solid investments. Let's look at a quick example. Imagine you purchased a house in 2015 for 50 lakhs and are now selling it in 2025 for 1.5 crores. With indexation, your adjusted cost could be 80 lakhs, meaning you'd be taxed only on the 70 lakh gain at 20%. Without indexation, you pay 12.5% on the full 1 crore gain. Depending on inflation levels, one option may save you more in taxes than the other. Experts believe that this change provides greater tax flexibility for real estate investors, while keeping capital gains taxation stable for other asset classes. Some analysts suggest that investors should carefully evaluate their options before making property sale decisions. Additionally, with no major changes to stock market taxation, investor sentiment remains positive, ensuring stability in India's capital markets. While the framework remains largely unchanged, the decision to allow flexibility in real estate taxation could influence investment patterns, especially in urban markets. Industry experts recommend closely monitoring tax-saving strategies to make the most of these provisions. For investors, the key takeaway is that while the fundamental tax rates remain intact, the flexibility offered in real estate capital gains tax could be a game changer for some. As capital gains taxation plays a crucial role in financial planning, investors and taxpayers need to assess their investment strategies in light of these updates. Understanding the tax implications can help maximize post-tax returns and build a more efficient financial portfolio. The Income Tax Bill 2025 brings stability to capital gains taxation while introducing new flexibility for real estate transactions. For investors and home sellers, understanding these changes can help in making better financial decisions. With no major shifts in stock market taxation, investor sentiment remains steady, while the choice of tax rates for property sales gives sellers greater control over their tax liabilities. As tax laws evolve, staying informed is key to maximizing returns and minimizing unnecessary tax burdens. For more insights into taxation, finance, and smart investments, subscribe to Living Matters and turn on notifications to stay ahead of the curve.